Hello to everyone. Well, I can see there's lots of people coming in, and we'll let everyone just come in the meantime. While we do, Lee has some very exciting news, which I'd like her to update us on. And she can tell us, she's the person that I know closest that's been on an airplane. It's like, it feels like we're talking about someone going on a rocket to the moon, but who's actually flown internationally, believe it or not, in the last 4 months. Where are you, Lee?
I am coming to you very excitedly from Dubai. I am here for the next 2 weeks while I wait for my charter into Saudi. But I am on my hop home, which is exciting after 5.5 months. And I joked earlier with Chad, every time I spoke to Chad, he said, I'm looking at that same picture behind you, because he was willing, just like I know a lot of our community was willing for me to get on that plane and get on home. But look, I've got a new wall behind me, interesting little pictures, and we're very excited. So thank you for joining us tonight. We love the fact that we have got people from all over the place that have joined us. There is a chat box. I'm going to ask you please just to pop in where you're joining us from and just let us know. So that we can see where we've got tons of people on this webinar. It's absolutely amazing. So thank you for joining us. I'm going to hand over to Scott, but as always, I'm going to be in the background, making sure that our panelists answer your questions. And if they don't answer it, I might answer you directly. But we're here. We're looking forward to a phenomenal webinar. So good evening to Chad and Andrew, and I'll hand over back to Scott.
Sure, so really interesting. We've got South Africa, Modderfontein, North Florida, California, Bedford, so England. So we've got a good bunch here. So let's rock and roll. We're excited to launch a new product. We're going to go on a journey here. We've got New York City as well. Wow, we've got all the financial capitals are coming in. All the family offices and bankers have turned up to find out what this new product launch is all about. We're going to go through a bit of a journey today, and we're going to learn some very interesting new stuff that I didn't have any idea about 12 months ago. And I'm really excited that 12 months later, it's going to be something that I too can invest in. So just to remind everyone, we're running this series on how to be financially resilient in the current COVID-19 economic environment. We do have our partners, one of them being Calio, that is a family office. The other being American Dream, that helps people get EB5 into America. They've helped about 400 people immigrate to America. And our partners tonight, Cashbox, who I'll talk a little bit about more. We've got 2 different people that are joining us tonight, and I'll let Chad explain his story just now. But Chad is a successful businessman and entrepreneur. He's a property and global investor and one of the founders of Cashbox. And again, Chad, I'm sure, can explain his story better just now. Andrew, I found a picture of you in a corporate outfit, and then I decided that I'd far rather have the Ultraman type athlete. You've got all the pedigree of international banker, family office manager, which we'll talk about. But what I thought was more fascinating is that every time I meet Andrew, he's doing some crazy race for 20 days through the desert or something like that. So if nothing else, a man that looks after people's money, but equally has a very strong mind in terms of all the ultra and crazy things that you do. So before I hand over to the 2 of them, I just wanted to, there's a couple of slides that we keep repeating. And one of them is this whole digital transformation and how COVID is changing it. Again, and if you didn't see Willem's webinars last week, I highly recommend them. How, 3 or 4 months ago, 60% of the Fortune 500 and JSC CEOs said that digital transformation was a top 10 priority. Now literally 95% of them are saying that it's a top 3 priority. And it's really, really important when you look at these trends, because whether we like it or not, when there's an adoption curve, it always starts with people in pleasure and then it goes to pain. And COVID has created pain, and it has 4 times greater adoption. Last week we did a webinar all around how technology is changing the world, and equally how value and wealth is being created in the space. So I'm not going to go back into that. You can go and watch the webinars. The overriding theme of this whole webinar series is Ray Dalio, who's one of the wealthiest men in the world. He runs the largest hedge fund in the world. And in April, right in the middle of the crash, he literally said the most important thing to do is to diversify across countries, across currencies, and across assets. And that's what Wealth 5.0 is all about. You know, in the old days, it took a huge amount of money and a huge amount of expertise to be able to invest in multiple assets. And now with our global ecosystem, we're really, really excited because different asset classes can come. So yes, we've got Wealth Migrate that helps people invest in property, but through our wealth diversification marketplace, we've now got access to other types of assets. And that's why we used to say it was the Amazon of real estate, but now we're thinking one step above that and saying, why can't it be the Amazon of personal wealth? And so without further ado, I'm super excited and very grateful to have both Chad and Andrew online tonight so that they can share some of the nuggets of what they've learned from their investment experience, not only with their own money, but with other successful entrepreneurs and investors. And I leave you with one thought as I stop sharing and hand over to Chad. The fastest way to be successful is to copy successful people. By the per virtue of what I'm saying, the fastest way to be wealthy is to copy wealthy people. The fastest way to be a good investor is to copy good investors. And so without further ado, I wanted to hand you over to Chad and Andrew that are both not only doing it themselves, but are equally helping others become good investors. Awesome to have you online, Chad.
Thank you very much. I'm going to grab the screen if I may.
Please do.
Host disabled screen sharing, I'm afraid.
Lee, can you enable screen sharing?
Done.
Got it there?
Done. Thank you very much. So Scott, thank you very much for the opportunity. Really excited to be sharing with the community. Know a lot of the people that are online and great to be chatting to everybody. Ray Dalio and Warren Buffett are probably inspirational people for all of us. And this particular quote around planting a tree really resonates with me and probably with a whole lot of us.
It's coming up. I was just about to say it's not coming up, but we're seeing your main screen now. So your introduction screen. Yeah, there we are.
Is it lagging? We're on Warren Buffett now?
Yeah, we're on Warren Buffett, yeah.
Great. The sign of a good demo is always the challenge right in the beginning. So we've got that out the way now. So hopefully we're all good. So Warren Buffett goes on to chat around planting a tree. And perhaps this is a fruit tree. Perhaps this is planting stuff that we know is going to bear fruit at a particular time, a particular season. And maybe it is that I want to start to plant a range of trees. Maybe I want to start an orchard. And maybe ideally something that I could live off, but certainly something that I could hand on to my children would be ideal. So Andrew and I have done a lot of work with Roger Hamilton and the Entrepreneur Institute, and this resonates with us too. So an arrow is a really powerful thing. However, it can only be guided by what you're trying to achieve and why you're trying to achieve it. This is the direction. This is where we're trying to get to, and how do I get my mind around this opportunity? Of course, when do I want to start? How am I going to get this right? And when do I possibly want to hand this on? Are all things that I need to and get covered. Skill step then comes next. And here's the power of the arrow. So how do I put power into this arrow? I create a bow. And the bow isn't just me. This is who I work with, who's going to guide me, how I'm going to go out and do this, and what tools I'm going to apply. So do you see then, as the archer, I've got quite a lot to consider and to make sure works. Now, if I could also put this whole system into a unit, into a system that I can go and multiply, into an area that's now protected, either legally, could be cross-border, and it could also be intergenerational. I now have an entire system I now need to manage. Very difficult because most of us are either entrepreneurs or professionals. We're not skilled in all these areas, and we shouldn't be. And in steps then the opportunity for a family office.
So can I talk a little bit about a family office, or do you, from your perspective? So Chad, I just wanted to I want to steal I'm going to steal the slide back from you, because for me it's interesting. I did put in two slides here just quickly around the family office, because it's such an interesting concept because probably 10 years ago, I'd never heard of a family office. And I'd love to know quickly and just interact with people, how many people have actually heard of a family office? So just literally in the chat box, just if you've heard of family office, or what do you think a family office actually is? So if you thought you were just coming along tonight to sit passively and to answer emails and look at your Facebook, we're going to keep you entertained. But I can see here, yes, no, yes. So it's really interesting. And, you know, I got, I don't know how I came across family offices, but I've had the privilege of helping wealthy people invest from many, many different countries. And what I realized is you've got wealthy people, and then you've got a level above wealthy people. Some people call them high net worth individuals, but it's actually above that. They're generally called the ultra high net worth individuals. And they've always got a family office. And what I've realized more and more is that, you know, the wealthiest people in the world have family offices. I actually went and did a bit of research in preparation for this webinar, and there's somewhere between 6,500 and 10,500 family offices around the world. And there's actually a website that I can recommend here, and I'll put this link in, a guide to family offices, which has all the details. Oops, sorry. And it basically breaks down how they do it and what their formula is and everything. But before I go any further, what I'd like to do is, you know, Andrew, when I met you, you're a family office. You help about 20 of the wealthy families. So you provide them this personalized service. What I'd love you to do, if you don't mind, is just explain to people what a family office is, you know, because again, I want to repeat to people, if you want to get wealthy, copy what wealthy people are doing. Now, with 6,500 to 10,500 family offices, the average net worth of an individual, according to the research I found, is about $100 million. Now, you're probably sitting here going, well, I don't have $100 million. And the good news is that's the beauty of technology, because Andrew's going to share with you what people that have $100 million are doing. And then Chad and Andrew are going to show you how you can copy them. Andrew, what's your take on a family office?
Well, Scott, thanks everybody. I'm based in Cape Town. Travel quite a lot, specifically up to Johannesburg within South Africa and abroad. If we could go to the actual screen here. So, you know, it depends, Scott, as you say, who do you want to get a definition from? And there's a wide range of definitions. But over the last 20 years, I'd like to think, if you take those bullet points in that screen and you boil them down, you know, whether you're a high net worth client, or whether you're an ultra high net worth individual or family, or whether you Joe or Jane public in the street, these tenets, these strategies, these points should actually form the core of what you are trying to achieve with your wealth management and your family's, the direction of your family or yourself as an individual. They should all ring and have a resonance with you in terms of what you're looking for. I think the difference with a family office is that if you take those blocks on that screen, they apply them with absolute discipline. Okay, there's a trajectory that they take, and there's continual reference to the family, to the individuals, in terms of the dynamics of that family, in terms of what they're doing, where they're coming from, and ultimately where they're going to. It is a journey. It's an evolution. It's very much like Wealth Migrate, how it started as a property company, as you said. You're now moving into a more diversified offering to your clients through your marketplace, your digital marketplace. So there's constant evolution. And, you know, if you go back to where family offices started, and that's perhaps in my next slide, I'll just run you through it quickly or shortly. It's come a long way, and it's evolving all the time. What's happened in the latest, the 21st century, the valuations of companies have created enormous wealth. You look at the tech space. People are looking for privacy. They're looking for confidentiality. And because they've got this enormous buying power, if you want to call it that, it enables them to diversify. And I'm not talking about diversification of asset classes. I'm talking about the fifth point there, diversification of skill sets. So, in a nutshell, if you want to hear it from me in a nutshell, in a paragraph, I'd probably say they are family wealth management advisory services, but they are different from traditional sort of private banks, because they manage wealth management solutions in a total outsourced fashion. They don't try and do everything themselves. They will go to the property expert if they need property advice, fiduciary or tax structuring if that's the issue, investment structuring, launching new businesses, destructuring and restructuring. And yes, at that level, you can afford to pay the best best of breed and best in their industries. But that is what's so important, is to acknowledge the fact that by adding their skills to yours, you overlay this, if I can call it an onion, with layer after layer after layer of skills until you pretty much are very well covered. So I think if, for a man in the street.
Could I just butt in there just quickly? Because I heard a good metaphor at one of the presentations where you and I were present in November last year. And it was described, a family office was described as an architect. So if people think of it as a house, you're not trying to be the plumber and the electrician and the gardener and whatever. You're the architect. You're the one that's actually helping design and build the entire house. And then you're bringing all the specialists. So I'm just using a completely different metaphor. But I quite like that metaphor because people can associate with that. And that family office is helping that family architect, their dream life, if that makes sense, and preserve their wealth and build their wealth. So it's just a metaphor that resonated with me.
Yeah, there's another analogy, Scott, that I use, and it's in that same vein. It's often hard building the house. A lot of people get worried about what are they going to put in each room. It's a bit like investing. Which investment you go into, which asset class you go into. Sometimes you've got to take a step back and say, what is the best way, what is the best structure to put all these investments in? So build the house. Because often what I find is that you come across a new client or a client who has, through his own design, maybe by default, maybe by inclination, has developed his own wealth strategy, his wealth pattern, and his portfolio. But when you start looking at it and deconstructing it, it's been cobbled together over a long period of time, as and when they've had funds available, as and when they've gone through their cycles of emotional and financial life. And you need to basically say, we need to break this down because you've built this house, but you've ended up with a sofa in the kitchen and the fridge in the lounge. If you, same sort of analogy, you need to build and create and design something that's going to be durable. And I think what is very durable about family offices is that they look after intergenerational wealth. The money of these families you talk about, maybe 100 million plus, a lot of that wealth, if you go back in history, a lot of that wealth has been generated through different generations. And you're really the custodian of that wealth. And if you take that, the point there of you need to have preservation as key in your strategy. And that's in the next slide, if we can go to that, Chad. In the next slide, you'll see, beg your pardon, one back. We've gone ahead. Beg your pardon. There, capital preservation. You've done the hard yards. People sitting out there listening tonight are probably thinking, I've inherited a lump of money. I've sold my business. I'm extracting value from a situation, from an investment situation. I've done the hard yards. I don't want to put that at risk. These families, at the core of many of the strategies, is capital core preservation. And because of that, they need to have that sleep at night factor, that they're not putting 100 years or 200 years wealth or recently gained wealth at risk for their future generation and their philanthropy and their legacy that they want to leave for their children. So intergenerational wealth succession is very important. They have the ability, and you should have the ability, to reach out to, whether it be outsourced services of tax planning, fiduciary, legal, investments, business acumen. You need to have those skill sets overlaid into your family office. But if we can go on to the next slide, Chad.
Can I just say one thing while you're popping over? Because I want people to be very clear here in their mindset. I'm talking $100 million, and I virtually guarantee you that out of the hundreds of people online, there's a lot of people going, I don't have $100 million, and they're switching off, okay? When you said custodian of wealth, whether you've got $100 million, $1 million, $10,000, or even $1,000, or maybe even $100, you still have to have a custodian of wealth. It starts with the right mindset, because the way to turn $100 into $1 million into $100 million is to see it like you need to be a custodian of wealth. And I just wanted to make sure that everyone that's on this webinar, this is for you. It's not only for people that have $100 million.
Yeah, no, absolutely. That's why I said on that first slide, those core points should be the trajectory of the man in the street, quite frankly. You know, how long is a piece of string? It's all relative in terms of length. But your core values is definitely mindset. You need to have a clear goal and vision, and this is what the families have, and they stick to it with absolute discipline. Understanding capital, what it's all about, what it's doing for you, and your advice that you're taking thereon. And again, delegating to the network of specialists, activate the skill sets. It's all out there. I think one of the most exciting things I've seen coming along in terms of the diversification, which is this golden thread that we've been putting through these webinars, is that you listen to Willem, or you listen to myself, or you listen to all the various speakers. They're talking about diversification. They are adding options of choice to yourselves in the community. And a lot of these options hitherto have not been within the public realm. You know, I think because of the size of family offices, because of the size of their wealth, they usually get very strong invitations to, you know, from other like-minded institutions, private banks, etc., to private equity, venture capital, you name it, that never actually go public. They certainly don't come down to the public level. So they're in this rarefied realm of asking for things as opposed to being given things. So it's a very subtle nuance. But when I was in Geneva, probably 20 years ago, when I first started out in this space, a very old Swiss bank, I'll just digress briefly. We were outside an ice cream shop, and I said to this fellow, I said, what's the difference between a family office and the man in the street who's got reasonable wealth? He says, well, the man in the street will go into that ice cream shop and he will get his snow cone, his sugar cone, he'll have a scoop of vanilla and a scoop of chocolate, and he might get a flaky in the middle, a chocolate flaky, and he'll pay for it. But he asks for that because he can afford it, okay? He'd certainly like to have all the exotic ice creams and additives, but he knows where he goes. So he goes and he gets given what he can afford. The family office, in the same analogy, would go in there and ask for probably a gluten-free, sugar-free ice cream cone, sugar cone with pistachio ice cream and all sorts of rum and raisin, all sorts of wonderful flavors. And then he'll have pistachio nuts on top, this, that, the next thing. And he asks for something and he gets it. That's the difference. In this rarefied space, the rules of engagement at that level are very different. The wealthy can create scale. And because of that scale, they can actually say to the investment banks or the businesses that they're targeting, say, this is what we'd like to do. This is how we'd like to see it work. Now, I think this is the importance of when Chad came to me on his particular journey, and I showed him, and I said, this is what the ultra high net worth families are getting in terms of return. He said something very simple. He says, this is not fair. He says, why can this not come down to an individual with $10,000 or $20,000? I said, because the investment banks, quite frankly, it's an inner circle, it's a club, and they're not going to get out of bed for less than $1 million or $2 million or $3 million for an individual structured note. So that's where the journey began in terms of finding the solution to bring these type of products with these type of returns to a person who's got maybe 10 or 20,000. So to participate in the type of lifestyle and the returns that the ultra high net worth family offices achieve. And one of the most important things is income, is sustainable, predictable income. And so with that in mind, when Chad said to me, he says, I'm earning really great returns from Wealth Migrate. How can we create the same effect through structured notes via the family office type of offerings into the space? So Chad, do you want to take that on?
Yeah, thanks, Andrew. So folks, my wife and I are very cautious. We went to the States. We went to go and have a look at the medical buildings in the beginning. We had a tremendous trip with Henny and Michiel and Yaku, and the Wealth Migrate team fell in love with medical, and we're getting 8% per annum without having to do any work. And to get that kind of net in hard currency is really, really hard to do anywhere else, and didn't have to put any time into it. So when I went out looking for another asset class, much like this fruit, and hopefully this is the fruit from our fruit trees, how do we get a mixed bag? How do we get a balance? How do we get a blend? And in asking a lot of questions, I was fortunate enough to meet up with Andrew. And Andrew said, look, for years and years, he's been doing stuff called structured notes, and we could match this. And we could do this by managing our risk. So the journey started out. I wanted to try it out. We started out first not understanding it. Then it went into a bit of disbelief. Then it went into shucks, the stuff's working, into some amazement. And then, as Andrew said, it then turned into a bit of anger, because for years and years I've been excluded from this level of protection and these strong returns. And I said to Andrew, this is not fair. How do we make this work? And what we then did is we went up and saw Scott about a year ago and said, hey, listen, understanding that Andrew could take a guy like me with a smaller number and let me piggyback on top of a whale who had a large number, and now we could participate. Suddenly I started to see a wealth migrate model building. So we ran it for 3 years, and lo and behold, it worked, and it worked really, really well. So, whoops, get my slide right. So Tony Robbins has this to say in Money Master the Game. Structured notes, these are perhaps one of the most exciting tools available today. But unfortunately, they're rarely offered to the general public because the high net worths would gobble these up like pigeon seed in Central Park. Luckily, and I think this was where Cashbox came in, the right fiduciary is able to grant access to individuals even without large sums of investment capital. And I love this because it turned out to be true. So how do we do this? And I was hoping, Scott, if you could give us 5 minutes. Oops.
Yeah, no, please play that video. It's awesome.
Yeah, cool. I just need to stop share and reshare. Sorry. Can't see it.
Okay, do you want me to get it up on my side?
Sorry, dude. There we go. Sorry, everybody. Here we go.
The difference between a dedicated investor who only gets access to retail-grade products and that of a dedicated investor who has access to institutional-grade assets is significant. You see, solutions are available to larger investors. However, most of us just don't qualify on our own. Solutions exist for predictable returns, protection, steady income by putting your cash deposits to work. Outside of these solutions, most of us are caught boxed into doing nothing with our cash or being directly exposed and vulnerable to high-risk, high-cost opportunities. And it is for this reason that Cashbox Global exists. To open up a world of opportunity for every investor by making our institutional products accessible, trusted, transparent, and highly effective. Because at Cashbox Global, we believe that every savvy investor deserves the ability to invest in the inner circle of protection and defined returns, to invest at institutional, not retail levels. So what we've done is gather interest from like-minded investors who have a minimum of $10,000 or more to invest, and put them in one box, a cash box of interested investors, if you will. So let's unpack the concept. Utilizing our strong relationships with the world's largest banks and product structurers, once the expression of interest per product from our members reaches over $500,000, we are able to take the opportunity to the banks to structure these strong, predictable return contracts, ranging from 6 to 12% per annum. The beauty being that the banks now deal securely and confidentially with each individual investor's platform in terms of their accounts, funds flow, and reporting, as they would for large investors. These solutions, known as structured notes, are contractually agreed upon and returned directly from the world's largest and most trusted investment-grade banks to you. No middlemen, no hidden costs. Your full investment is placed in these bespoke income and growth notes. A steady delivery of up to 3% per quarter available in US dollars, pound sterling, and euro on request. You may ask, how is this possible? As you know, banks make money by charging you for the money you loan for your car, home, holidays, business, etc. Banks can only lend out a defined percentage of the cash they hold. Therefore, to grow their businesses, investment banks need to keep attracting large cash deposits from larger investors for longer terms. These cash deposits typically come from the largest of investors who have been loaning money to banks since they were invented. To make this attractive, banks pay above average returns and build in levels of income and capital protection for these specialized structured loans. Through Cashbox technology and relationships, you and I can get access at last to the best protected income generating assets from $10,000 or more. So in a nutshell, who are the parties that make up the Cashbox magic? Firstly, there's the investor. This could be you. And of course, you have your trusted advisor, financial planner, tax consultant, or coach that looks out for you. Any investor should have an online investor platform to hold and report on your investment assets. Then there is us, Cashbox. We introduce you to the deal that our partner, iDad, has structured with the last role player, the investment-grade bank that wants our group of investors to contract with them. And as a collective, we channel you to predictable, protected income streams. Sound complicated? Not at all. This is how it works. 1. Register as a member on Cashbox. 2. To complete this, you will need to supply us with the online investor platform you will be utilizing. Should you need a platform, there is a list of accredited platforms on our website. 3. Once you're up and running, you will have access to opportunities to A. Invest, or B. Pledge. If you choose to invest, we supply you with the ISIN number and a defined closing date for subscription. If you opt to pledge, we book build investors' interest and intention towards investing in a product. Once the expression of interest reaches minimum capacity, the investment can go live. Again, we will notify you that the investment is active and supply you with the ISIN number. 4. Now you are ready to instruct your investor platform to invest in the ISIN per their requirements. Then you can sit back and wait for your predictable income stream. Enjoy your returns and reinvest what you can. Cashbox will keep you updated throughout the process because your peace of mind is our business. Now that you know what's in the box, be poised for new opportunities. Partner with Cashbox and fly.
Cool. Thanks, Scott.
Yeah, it's awesome, man. Very well done video.
Yeah, it's cool.
What did people think of that video? You know, it's always hard to make something that's could be seen to be so complicated simple.
I'm so excited. Last day I'm at school. Rave, like very fast, energy, neon colours. When steps in the rave, like you know what time it is.
Where's that coming from?
Diva of the group.
That's Chad who's doing that.
Oh.
That's embarrassing.
I was like, wow, you're a bit like Tony Robbins. You give yourself your own applause.
That was Vimeo carrying on in the background. I promise I didn't cue that up. I don't know how. Nice. Can I share again?
Yeah, go on, please. So yes, the profits are paid back into the wallets. So everything on the platform goes back into the wallets.
That was funny. All right, so folks, we're back onto the table now, right?
Yes.
Okay, great. So folks, ideally what we're doing now is in our predictable income area of our investment universe, we've now got syndicated medical that we used to with Wealth Migrate. Alongside, we could start to put in 8% Cashbox notes and slightly higher ones as well. There is some stuff in growth. Because the challenge right now for all of us, there's cash sitting in bank accounts in hard currency around the world, earning zero. Other option is bonds, maybe between 2 and 4%. Not very exciting, but I tie that up for 4 to 5 years. So the Cashbox notes now create a tremendous way for me to diversify this fruit that we're living off, that I can either take as income and reinvest or income to go and live off. And I'm really grateful for Andrew for showing me this and getting me involved with other high net worth well, with his high net worth, so that we could go and create the same kind of returns over time. So in putting this all together, I think Andrew and I resonate, and this was really created for our families. My mother-in-law is to blame, my children, Andrew's kids. We really, really believe that with the right opportunities and the right knowledge and the access to safe institutional grade investments, I'm not talking retail, institutional grade investments, we can all compound our way to financial freedom. So as you said earlier, Scott, if you started off with 100, 10,000, the million, this could keep compounding and compounding. Certainly the wonder of the world. And importantly for us, this financial freedom unlocks the ability for all of us to go and create more value to the world. So if it is that this gives us the opportunity to go and live out our passions and go and contribute more effectively to the world, perhaps it is that through something as simple as this, we can create opportunities for families and for communities, and maybe even start to reshape the world. So we resonate with you, Scott, and going after the world's global challenges. We certainly believe this is a tool to get after it. And if everybody can invest in the circle at last, I think Andrew and I have done our job, and we're really, really excited about that. So what we've done, ideally, we want to step out and help our investor community. We've been running with these products that have been available for 20 odd years. We've been running with a smaller community for these last 18 months to prove it. And it's been really, really strong for friends and family. And we would love to offer this then to the greater community because we believe that they are looking for something like this, and it certainly offers the diversification they need. So we'll help you access these investment opportunities with guaranteed rates of return. And these are directly folks from the world's largest investment banks. Now, these were only accessible to very large investments before, but following the Wealth Migrate model, we've been able to change that. Steady rates, 6 to 12%. And what's incredible, and I'll show you just now, whether the markets fluctuate or not, whether they rise or fall, is the window in which these pay out, which is unheard of in traditional equities. So to have a look at this, if traditional stocks, we would buy with the hope of a stock growing. So let's say these are years. I buy Tesla, I buy whatever my stock might be. The intention is that I hope it would grow. If I sold it at any point in time, I would take the growth, and that's my profit. But as we've all seen, here's a traditional loss. The stocks can go the opposite way. What a structured note does is this red line, and it pays out a predictable income, steady, 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 month on month, whether the markets have risen or they've dropped within a particular band. How's that possible? We buy insurance with this contract. Here's the power of structured notes. So let's structure a note. Let's have a look at an example. Let's say we're targeting 2% a quarter, 8% per annum, and it's capped at 8%, whether the market shoots above that or not. And let's say we want to buy income protection. And in this case, and we're going to show you the product tonight, even if the markets fall, Scott, by 50%, it would still pay out my quarterly income. And we also buy what's called a memory feature. So now let's say the markets go through March's big drop, and Andrew's going to take us through an example just now. Let's say we do breach the 50%. We've actually bought insurance that says when the markets recover and get back above that mark.
Well, we launched the slew of it.
Was that me again?
That was me, sorry.
So if the markets recover and they get back over that 50% mark, Scott is going to pay out that quarter, look back and pay out any lost quarters. Quite unreal. Then the capital protection, our capital is protected through the life of the product until the very last observation. Let's have a look now. So let's say, for example, on this line, you can see my mouse, I hope. Their start value, and let's say the start value is at 100% or $100, doesn't matter. We've bought protection, you'll remember, all the way down to 50%. So these stocks can halve in value. My income and my capital is still protected. in this example we're going to explain. And we spoke about the memory feature. So I'm going to run through a example to see how this works. So let's say we start, let's say November last year, we bought a basket of products, and the first quarter comes around, markets are risen, it pays me the 2%. Because you see I'm in the money, I'm above the 50% mark. Quarter two comes around, gosh, the markets are starting to go the wrong way. It still pays me because I'm above the 50%. Quarter three comes around, the markets are plummeting now. Maybe we've lost 30% in the market. I'm still above 50. It's still going to pay me out my 2%. Can you believe it? I then get to quarter four. Let's say quarter four drops, let's say that's a 45%. Do you see I'm now under my capital protection level? This coupon won't pay out. My capital isn't lost because my capital is protected for the whole period. But do you notice it doesn't pay me in quarter four? But don't worry, don't stress, because we bought this memory feature. I hold on, I sit tight. The markets recover. Let's say quarter five comes around. I get paid out quarter five's 2%, plus it looks back and pays me this missed coupon. So can you believe it? I get my full value back. So it's highly unlikely that you're not going to get your full payment through a year. And Andrew's going to take you through the market crash in March. So we continue, and let's say the markets climb, and perhaps it is that in one of these quarters, the markets really, really rocket, and maybe we shoot past 20% growth. Remember, I bought a capped product. I'm still only going to get the 2%. Now comes the tricky part and the piece that we need to concentrate on. When we get to the last observation, the last date of this product, let's say it's a 5-year, and the stocks are, let's say, have dropped by 20%, I'm still within the money. I get my full capital back. I get my full capital back even if the products drop right the way to 50%. But should the product breach the 50% mark, let's say I close out at 46%, it's as if I owned the stock and I was selling out. So if the stock market was at 48% at that point in time, I would get 48%. But what you'll notice when Andrew chats through the products, we take great, great care to make sure that we buy the right stocks that would never reach this particular mark. But here, we now have a guarantee, and we're going to show you just now, directly from Credit Suisse Bank on exactly this thing and how it's going to pay out. These have been remarkable. Smart. So let's have a look at recent products. Andrew, would you mind taking us through these?
Sure. So if you just pump up what's on offer. So we're going to have a quick look. February, what we did in February. And this was pretty much launched in the dire days when Corona was thought to be an Asian problem, and then the contagion spread rapidly. And companies, markets, economies, and countries started wilting and faltering. And a great deal of distress started seeping into, for example, equity markets, bond markets, cash markets, everything. This particular product was launched in February, so we hadn't seen the worst. The worst of it was still to come. It was built in with, as Chad said in the previous picture, 50% protection on the capital, and your income level was also, as long as the underlying investment didn't breach more than 50, you would get your coupon. So, at the 23rd of March, with the brilliant clarity of hindsight now, we can look backwards and say 23rd of March 2020 was the low point of the year thus far. We're hoping it's not going to go back there. But certainly that was the low point. Nobody knew when it was coming, but looking back, it's quite easy to say. So this particular product launched. We launched it very carefully in terms of companies that were exposed to pretty much the working from home, the social distancing, all that kind of stuff. So Twitter, Apple, Nvidia, and AMD. The top two are microprocessors, chips. It's in the big tech space. These companies are all big tech, and we'll show you how that's proved to be resilient right throughout this period. Be that as it may, there you can see the start date, the 14th of Feb, the first coupon. So that was 2 months after the low. It paid out its 3.3%. So this had a 13.2% per annum contractual return. This is a contract we go into as Chad said, it's capped. You can't earn more, you can't earn less. There's a contract that sets up the terms and conditions of what you earn. So it's predictable. The dates are predictable. There's a chart that follows, which shows you the actual dates that it gets that actually gets observed and paid on. There you go. So you can see on the 6th of May, we had our first observation. That was the first 3 months, the first quarter from inception. The 14th of May, it was paid out. And certainly, again, 7th of August is going to be the next one. I can tell you something by going to the third sort of screen, which is anecdotal in terms of what the charts, what the stocks have done. You know, it just shows how strong and resilient these companies have proved in the face of devastating economic news. So by way of example, Twitter, the line right at the bottom, the share right at the bottom, Mr. Trump's favorite, that dropped at the 17th of March. The 17th of March was its low water mark, and it was basically approximately minus 40. So as Chad pointed out, well within the minus 50 that we had built in. Minus 50 is a very, very deep protection level in terms of a protection that you've bought. As we moved out of those lows of March and May, there was a check. Obviously, the recovery was underway. You can see it went from 22 to 30, so minus 17, and currently it's at 36. So it's just about back to par. You know, if you look at some of those of its compatriots in the stable, you know, you're looking at some of them in, you know, double digits and high numbers in terms of recovery. But we don't participate in that growth. That growth buys us the protection. It buys us the deep income triggers to achieve this coupon. It buys us the memory feature. So there's always a trade-off. There's a trade-off in terms of what we can do. This particular stock, this particular investment has also an opportunity to what's called early mature after 12 months and every quarter thereafter. So in other words, what I mean by that, come the fourth quarter, if all those prices are above their start prices of the 7th of February, this will automatically mature early. The clients get their money back, all the coupons, and they've got a now new position to either reinvest, reassess what's happened. Again, as the family offices do, they always have reference to what's going on, to evolving. There will be you know, sort of new opportunities, and it might be a short-term strategic move. So this certainly has proved its point. Now, this shows you that it validates in very, very unusual, exceptional market conditions. We've never seen something like this. I mean, the last medical pandemic was 1919, Spanish flu after the First World War, which wiped out 5% of the world's population. So this is small by comparison. But the fact of the matter is nobody knew how to deal with this. And there were two options: either invest, as this one did, with deep protection, or rush for the doors and stay in cash on the sidelines and earn nothing. You know, interest rates are going to remain as they are. So this certainly presents a great opportunity. And this is where the savvy investors, the family offices, say, well, I'm not going to be greedy. I need a core and I need predictability and I need to preserve capital. Remember, the core of this is preserving capital and generating that well above average coupon return. So Scott came to Chad and myself a while ago and he said, as Wealth Migrate moves into its next evolutionary sort of level, he said, we're looking for something for the Wealth Migrate community to complement, to certainly complement the Wealth Migrate medical 24, 27, 23, 17, whatever it might be. We need something that has resonance in terms of cost, in terms of fees. We're cutting out the middlemen. You've seen that in the video, the middlemen going out and creating as much return and delivering that through the wallet and the platform, basically back to the investor. So he said, I want a big bank. Andrew, find me a big bank. He says, I want great terms and I want great in US dollars and sterling. Wealth Migrate traditionally been a dollar-based company. And I think like everybody, there's clear evidence that dollar is going to come under pressure. It's not an economic lesson, but there's diversification in currency.
Sorry, Andrew, just a very quick one. If you haven't seen the webinar with James Painter, I would highly recommend it, talking exactly about what you're talking about on that currency. And you know, he's been excellent at predicting where markets are going. And you know, he said something along the lines of the dollar was going to depreciate against the euro by anywhere from 50 to 80%, which I found fascinating. and the pound was, off the top of my head, was 25 to sort of 50%. So it's just really interesting, and again, another reason why you can't have all your eggs in one proverbial basket, you know.
So, you know, I said to Chad, we need to go out and find the best of the best. Now, Cashbox products, the banks, the institutions we deal with, and that IDAD have these very good relationships with. And I know Graham McCallan from IDAD is on the call tonight, so he'll probably give us a scorecard later, Chad. But certainly, these are the big, large institutional banks in the world. These are the A-rated banks. And what I mean by A-rated banks, they're credit ratings, and you can see on the right-hand corner there. So the same banks that downgraded South Africa and our banks are the same banks that put these guys under the microscope. And, you know, these are very, very strong ratings, even though the stresses that banks have been through in the last 6 months, and they're under major stress. So certainly, this was on a quarterly basis to match the Wealth Migrate's income flows. Auto call, again, we've got that after 12 months. This is a 9% coupon, 2.25 every quarter. And again, deep levels of protection, deep levels against capital risk. And we've chosen here, this is very interesting. You'll remember in the previous one, which is a bit sexy and it's go-go. This is big blue chip behemoth, as the English call it, sort of chips of the London Stock Exchange, almost household names. AstraZeneca, Lloyds, Barclays, and BAT, British American Tobacco. In fact, Lloyds and Barclays, a client said to me, and I've showed him this, he says, why two banks in the same basket? And the work that IDAD do in terms of their due diligence and their modeling with the investment banks is very interesting. And one of the features and facts that comes up, and it's in the property space, so you'll enjoy this, Scott. Between Lloyds and Barclays, currently in 2020, well, this is as of March 2020, collectively they have 65.6% of all issued mortgages in the residential space in the UK for home loan mortgages. So there's a subtle story in that, and that's why this is just not pull both triggers and put them in the basket. There's a subtle story in that. If 65%, if these banks came under incredible stress, where worst case scenarios they fold, and that's the risk that a bank folds, and the same goes for Credit Suisse, that's why we go for such high ratings. What would happen to 65% of those mortgages? Well, what would happen to the 65% of British people who had mortgages? They'd probably lose their home. So that kind of scenario goes to the fabric of English society, British society. The Bank of England has got a precedent of bailing out banks, rightly or wrongly. So we feel that at the end of the day, there's added reason why these banks will never fail or won't fail hurriedly. Not never. Never is not a good word to use. So certainly very, very carefully chosen. They are complementary. The other issue here is that these used to be probably, and BAT still is, some of the highest dividend payers in the UK stock market. In other words, people would buy them not for growth, they'd buy them for their 6 or 7% return. Most of these banks, either rightly or wrongly or under pressure, have withheld dividends simply to save their shareholders, protect their businesses, and protect their customers. So what that means is people who are holding them for dividend are now struggling because the dividends aren't being paid. So what we've done here, and I took the words from Ken Williams, part of the Wealth Migrate board, and Ken said, you know, he says, this is brilliant. He says, because effectively what you're doing is you're guaranteeing a dividend payout through this contract. And he said at 9%, which nobody's paying at 9% at the moment. The highest divvy pay is around about 7%, and that's BP, British Petroleum. So this is a fantastic product for predictable earnings for these large companies that aren't going to go shooting out the lights. Chad's got a great word for it, steady eddies, which is exactly that. It starts forming your core. It's that sleep at night factor. It's the predictability, and it's the protection. Plus, very nice 2.25% every quarter. So this is what's coming out in August. We're busy with it. This is going to be on the pledge. This is going to be available. And I think if we go to the next slide, it's very important to see, how do you avail yourself? How do you get into such a product? Now, this is essentially the investment process. Scott's going to go through a little bit, but the conversation we had with him a year ago, he said, the team with Lyndon and Gavin and everybody, we are moving to a digital marketplace, an agnostic marketplace where we can offer diverse opportunities to our community. And essentially, in this instance, you are a part of the community of Wealth Migrate. They would be your investment platform through your wallet. your funds flow directly. There was a question earlier I saw. Your funds flow directly from your bank to your wallets and directly, through the Wealth Migrate platform to the investment bank. They never go to any of the intermediaries. They never come through our fiduciary accounts, trust accounts, through the structures, IDAT. It goes directly, and vice versa. When the coupon is generated, it comes directly back to the account from which it came, which would be your Wealth Migrate account. So there's very clear lines of sight. There's very good governance. There's audits. There's control. It doesn't go through a myriad of trust and escrow accounts. It's very, very simply put together. And I think what I'd like to do is hand over to Scott now to show on the, Scott, with your tech and your smart investing, essentially what that goes for. Mark, ISIN, so if I can just jump in there, it stands for Investment Security Identity Number. So every single registered investment, that's actually a Bloomberg's, it's registered by Bloomberg, so it's very transparent. The ISIN is really the acronym. So every investment has, whether it's a unit trust, whether it's an open-ended investment company, whether it's a structured note, whether it's a share, Wealth Migrate have ISINs on their properties. So registered listed investments have this reference number, which basically means they are completely transparent, can be tracked, can be broken down, etc., and viewed independently. Over to you, Scott.
No, brilliant. So I just want to summarize what I've heard and more importantly, what I've learned in the last 12 months. So when it was actually, I always forget the name of that hotel, but it's the nice hotel down in Constantia. And I met with Andrew and Chad back in April last year. And Chad said, I've got a good idea. Just like we're doing medical buildings, we should do structured notes. And I was like, what? Now, again, I'm not trying to be arrogant, but I've helped people invest for nearly, well, basically 20 years. I've invested myself for 20 years. I've got 2 degrees, one from South Africa, one from London. You know, I should really know this stuff, quite frankly. And what I found really interesting was I'd never heard of it. It's not like I even knew, you know, it's like in commercial property, I knew that I should be investing in commercial property, but I just wasn't because I didn't know how to. But with structured notes, I'd never even heard of it. And in simple terms, if you take that video and what Chad and Andrew just showed you is that, you know, the reason I didn't know about it is that you couldn't even get into the room unless you had $1 million, generally $2 million. And again, by using technology, what they were doing is allowing people to come together. So think of it exactly the same way as buying a commercial building. You couldn't buy a commercial building unless you had millions of dollars yourself and the know-how and access and everything else. And now with technology, it allows a number of us together to come together and invest like the institutions. Well, it's exactly the same with a structured note. Now, I want to be very clear tonight. No one, not Andrew, not Chad, not myself, is giving financial advice. All that we're doing is sharing with you another asset class, because as Ray Dalio said, and it's literally the essence of this marketplace, this wealth diversification marketplace, is the most important thing is to diversify across countries, across currencies, and across assets. So if you take the wealth diversification marketplace, you can literally log in, and we will put it in the chat box. If you don't have it, I'll put it up there for you. You can see I'm logging in here, and to someone that was asking the question, if I go in my own name, you can see that I'm actually, you know, my wallet and everything is there. So all the functionality you've got on Wealth Migrate, it's the exact same functionality. And what you basically got in the alternative marketplace is alternative investments, not just property. So if we go down here, and you can hopefully recognize the Credit Suisse branding, it's pretty easy. And you literally go in, you can go read all about the deal. You can read about the different market summary, the investment summary. You can read all about Cashbox, which is the company that I nearly said, anyway, I basically mixed up Chad and Andrew, and like I was going to call you Andy and I don't know what, but, and then the due diligence provider. And by the way, these guys have done over 1,000 of these structured notes. I stand to be, forget the number exactly, Andrew, that you told me, but they've been doing it certainly the last 15 years or something, isn't it? How long is it?
Yeah, so it's about 1,200 products. Well, certainly that's in the last decade. And of those, more than likely, the last I looked, it was around about 96% of them had delivered exactly to the terms of the contract that stated. So certainly what they say on the outside of the box is on the inside of the box in terms of, you know, back testing and looking over a 10-year period. What have they produced, and has it produced what they have said they were going to produce?
Perfect. So if you look on the right-hand side, you can see the minimum investment is 10,000. you know, I know that both the gentleman and myself and the team ideally want to be able to bring those numbers down with time. That is the minimum investment at the moment. It is a 6-year term. Is that correct? Is it 6 years or 5 years? It is 6 years, huh?
Yeah.
6 years. And the total return, the total cash on cash return is 9%. The reason that the team's got 8.1% there is just for clarity, because there's an amount that's withheld from a tax perspective. It is still your money and you can effectively write it off, but we're just wanting to be absolutely clear. From a risk perspective, it is a core asset. You know, like Andrew's already alluded to, you're dealing with one of the top 10 investment banks in the world, with one of the highest ratings in the world, and even the underlying assets are equally high. So it's not going to shoot the lights out in terms of capital growth. There is no capital growth. It's protecting your capital, and it's paying you a very good income in diversification. Then you can go and read all about the product overview, and you can also read about the fact sheet, et cetera, et cetera, et cetera. And the good news is that it's actually all available on the platform. So you can literally go in and you can invest in this deal. So if you're interested in this opportunity, it's literally as simple as funding your wallet. I'm actually funding my wallet at the moment. You can see that my problem is that everything I've got is in overseas entities. So if you want to see how this structure works, and my overseas entity is purple and pink, so I'm waiting for that to be KYC'd. So, or no, it's actually called KYB'd, Know Your Business. And once that's done, then I can update it. But because I personally am going to participate in this, I found it very fascinating that about a couple of months ago, I forget exactly when it was, about 3 months ago, we decided to go out to our top 100. So we've got 100 people that generally constitute our top investors. And Chad and Andrew and myself and the team went out to those top 100. And I'm not going to lie, and I apologize to Chad and Andrew for this, although I've already apologized. When we sent it out, I was waiting for a bit of sort of, you know, kickback, whiplash, I don't know what you want to call it, with people going, you know, what's this rubbish you're sending and we don't understand and whatever. And I actually had the complete opposite. Generally, the wealthiest people are already investing through family offices. And every single family office, without fail, in fact, I've yet to meet a family office that doesn't have some part of their balanced portfolio in a structured note, which I just found fascinating. I was like, why doesn't Scott Picken have access to this? Why is Scott Picken not investing in this? Like, so I went through that same anger that Chad is talking of, where I was like, I'm not even in this asset class, let alone benefiting from it. And so that I found really interesting. And the majority of the wealthiest clients that we help already had some sort of exposure in this environment. The important thing is, and again, I'm not giving you financial advice, but I am sharing with you what the wealthiest people are doing in terms of balancing their portfolio. And so buying predictable income in terms of real estate and commercial property has huge benefits. But equally in these structured notes, they're a different asset class, you know, different currency, and it gives you that diversification that Ray Dalio spoke of. So from my side, Andrew, you know, I wish I could say that it's more complicated than this, but actually someone goes online, they literally, you know, participate, they invest in the deal. It's all through the platform. All their returns come back into their wallet on the platform. And the nicest thing is that, you know, I can literally go, I don't know if you guys are even aware of this now, but we've actually got all the cross-currency jurisdictions. So you can immediately see what your global wealth is in any currency, even rands. And you can go and see if you want to feel like you're getting wealthy, then you put it in rands because it makes the numbers look so much bigger. And you can literally sit there and you can see exactly where you're at. You can look at your entire portfolio. You could log in and see your wallets, and everything will be, you know, all your different investments will be funded there. As I said, from my perspective, these are the only ones I've got in my own name. The rest are all in my company structures, which I need to, which I'm trying to get KYB'd at the moment. And I don't think there's really too much more to say about this, because the thing that I like most about this, and I want to sort of finish with this comment, Chad, is that what you said to me is that for your family, the most important thing you want to achieve for them is to be able to create multiple predictable income streams. Because not only if for yourself and your wife and that would give you the freedom, but it would equally give your children the freedom and hopefully create generational wealth. Could you talk to me just a little bit about that? Because, you know, I want people to take 30 seconds. And just imagine that if this was their wallet and every quarter there was multiple income streams coming in from structured notes, from medical buildings in America, from aged care buildings in England. Maybe it's different structured notes in different, different stock markets with different currencies. And all these predictable income streams are coming into this wallet. And literally, you don't have to do everything every month other than, go and look at your wallet and decide what you want to do with it. And if you're a wise investor, you're going to take the majority of that and keep reinvesting. Like we said, as the custodian of wealth. But Chad, talk to me a little bit, please, about that, what you were talking about. And I'm going to stop sharing my screen here. In fact, no, I'm not going to stop sharing my screen. I'm going to go to this slide here, which is what I wanted to share here, which was just, the links and where people could go. And if they wanted to, talk to one of the wealth consultants or, go directly to the platform or even WhatsApp Lee, who's our head of community. But Chad, please talk to me about that predictable income, because I found you really opened up it's not a wound because it's the opposite of a wound, but a possibility for me as well, where I build my capital in business. I try and deploy my capital in real estate, and you open my eyes to say, okay, cool, real estate's good, but you need other predictable income asset classes. And to be honest, there's nothing else I trusted until you had opened my eyes to this.
So Scott, for myself and for everybody else that's listening, I think we all work really, really hard to create some sort of income, and that's through many hours and probably taking risk in who you work for and the businesses that you have. But now if you could take that disposable income and reinvest that or invest that into predictable income assets, and I love property. As I said before, I think I'm property heavy, and I needed to find something else, because the intention then is you're starting to plant the Warren Buffett orchard. How do you get these fruit trees to start to propagate? How do you keep perhaps eating off some of it and replanting and growing this even more? Because I think to give my kids a head start from where I started investing in retail products. As I said, it made me mad. And what you've done, Scott...
Just to be clear, a retail product is where you might be earning a return of 3-4% through to maybe 6%. And you actually feel quite excited until you realize inflation and you are having a good race and inflation's often beating you.
Absolutely. And maybe you'll be surprised to know, but structured notes have been around a very long time and banks offer them as retail products. But you may get half the return you're seeing now, to your point. So how do I get my kids in at a level that becomes affordable? And this is what really attracted to me.
Sorry, Chad, I know I'm butting in, but you've just said something very important there. So why is retail 3 or 4% and now you're being offering 9%? And something again, because I asked you this question, and I don't know if you want to answer it or if you want me to answer it the way I heard you say it, but why? I mean, why are retail banks only offering 4 and now suddenly you can get 9?
Because those are big buildings to look after. Those are big institutions that are hungry. They need to create returns for their shareholders. They need to pay big bills. But now they're going to pay advisors and other people in the queue. What you've done with Wealth Migrate is you've taken us directly into the medical building. What Andrew's done with the structured notes is taking us right into the bank. There's nobody between us. We've cut all those middlemen out. Now, I think it was you that told us 1% difference in a return would make a 10-year difference on your retirement, something to that effect over a period of investing. I mean, that's significant. And if we've compounded that, and now you add another 3% or 4%, and what made me mad is, Scott, we're not taking risk. Well, sorry, we are taking risk. It's very managed risk compared to trying to find a return like these by taking extraordinary risk. So, and it's Andrew's children, it's my children, it's my mom, it's my mom-in-law, it's sisters, it's you, it's the whole community that I'd love to help, that Andrew would love to help. And I bet you, Scott, within this community are other products we're not yet aware of. I didn't know structured notes till 5 years ago. So what else is out there that this community could be sharing. That I found very powerful.
Well, on that note, I purposely, so I shared, if people look in the chat box, you'll see the two videos that I shared, which was it was like introduction 1 to structured notes and introduction 2 to structured notes. There was a video that Chad has there, which is called, you called it Wealth for Entrepreneurs or something. What did you call it? Freedom for Entrepreneurs.
I did the video for Roger Hamilton's Entrepreneur Institute. I'd actually love everybody to watch that too. Maybe not everybody's an entrepreneur, but I think it speaks to the spirit. And it's certainly the training that I'm trying to give to my children, my wife and I.
Okay, well, sorry, just before we go there, because you were talking about your children, and I completely interrupted you. Lee, would you please put up the poll? And anyone that fills in the poll, we will send the video that Chad has done. It's a 30-minute video. I've watched it. Chad is a mentor to me and a very successful entrepreneur himself. And I really, really enjoyed it. So I highly recommend watching this. It's a 30-minute video. It's action-packed, but it's only for people who fill in the survey. You were talking about your children.
Scott, you're amazing. Yeah, now I'm lost.
So we were talking about the predictable income. And I said to you that the thing that where you opened up an opportunity for me was the idea of being able to invest in property and in structured notes. But the most important thing that I liked about what you said was the safety that comes with multiple predictable income streams.
Yeah, absolutely. And it was Andrew and our trustees who asked my wife and I, yes, it was a really tough question to answer. How would we like to see our funds invested, and how would we like to see the trustees manage our children the day we can't? Yes, it was a tough one. And maybe much like the bow and arrow, and Andrew gave us a lot of guidance because he's run big families, multi-generational, complicated stuff. And really we got down to, please invest in stuff that's not risky, that's going to produce a steady income, that the children could live off the income and never off the capital. Because that way, if anything goes wrong, the capital is never at risk. We love that. And through that, we could probably maybe generate something that maybe grandchildren could enjoy. But certainly, if everybody went on the same journey and way earlier than what we started, I think we'll all be way better off. Hey, Andrew?
Yeah, absolutely. It's evolution. You know, the traditional investing models has been according to your age. Take more risk when you're young, and mitigate that risk as you get older towards your retirement years. In other words, to avoid any degradation to your capital base that you've built over that long period. I see more and more younger people opting for something that's a very solid core, which is going to churn out a predictable growth, a predictable income. And around that core, they'll have sprinkled maybe some more exotic stuff. Irrespective of age, it's a very interesting change in dynamic. And that's irrespective of wealth. I see it in very, very wealthy families that we manage. And I also see it in youngers, not just the young millennials, but I see it in young professionals up to sort of 35 years old who are taking the choice to say, well, yeah, there is the possibility that I could make 40%. There's also the possibility I could lose 40%. Or do I start building a core, a safe, predictable core that's going to churn out, 10, 12% US dollars. And around that, I'll start building my other sort of options. But multiple income streams is certainly a hallmark of family offices. Again, it's diversification. It's like if one particular asset class is not working, another one will. So, property and structured notes are a world apart. So there's huge diversification in terms of asset class. Nice to say that there's a close correlation in terms of the type of returns they're giving you for the type of risk that you're exposing yourself to. And I think the other advantage is if you look at the pedigree, it's all very well to say, yeah, all the family offices have exposure to this, but the pedigree of the type of institutions that you're aligning yourself to, the big A-rated banks in the world, structures that got, a track record that IDAD has, the wallet system, how it's been endorsed by Lemonway, you know, in terms of, I mean, Scott, he was wanting to do cartwheels when he heard that they'd been approved and they were on the, I think he was in Cape Town when it came through. He was almost speechless. The guys were very, very chuffed. So there's an alignment to big heavyweight players. There's an alignment to a resonance of behaving the right way. You know, not just having your financial compass pointing the right way, but you know, you hear Chad and a lot of the clients I represent, there's a moral compass. It's not all about creating an extra zero on the balance sheet. That's important, but do it the right way and do it sustainably. Do it over the long term. So as you say, Chad, your children will take over this mantle and pass it on to theirs. And you started the intergenerational, you started your family office.
So there's a couple of questions here that I'm just going to, in no particular order, just go through them. So Willem said that's 10,000 GP as in pounds, not USD, right? I'm not actually sure because I think it's a pound-based investment. So the minimum is 10,000 pounds. Is that right?
That's correct for the pounds and $10,000 for the dollar.
Okay. Marcus said, please can we have that in euros as well? So we did actually put up the poll and we'll share the results with you, Andrew and Chad. Very interesting. The majority wanted pounds, the second wanted euros, and the third wanted dollars, which is fascinating. Rachel said 9% per annum. So yes, Rachel, the returns are paid quarterly, but per annum. So it's 2.25 per quarter, which is 9% per annum. What is the difference between Wealth Migrate and the wealth diversification? So in simple terms, Wealth Migrate has property deals on it, and the wealth diversification marketplace has the alternative investments. The reason being is we don't want someone to come along and invest with the Credit Suisse logo and think they're investing in the Credit Suisse head office. So it's just keeping it simple. Maybe we need to bring them all together in the near future. It's a debate. We'd be fascinated on your opinion. We are trying to make it easy though, and the beauty for me as an investor, I mean, you can see I can switch between them. All my money's in the same place. It's literally like going from Gmail to Google to YouTube, if you know what I mean. It's the same login between all the things. Hi, Mark. Lee's answer that. Will we be seeing any structured notes that use ethical underlying? Okay, so that's quite interesting. From your perspective, Andrew, I think that's certainly something to put on the radar around green energy and the likes.
Yeah, Chad, Scott, we've actually done quite a lot of work with our counterparties, with the structures in the ESG space, the ecologically sustainable and compliant space. So yeah, very much so. It's a growing trend. It's a very, very exciting space. So we're talking about green energy. We're talking about renewables. We're talking about companies that espouse a mandate to do things ethically, do things the right way on a sustainable manner in which carbon and destruction and plastics and all these good things we see or bad things we see on TV, they sort of shun. So there is a big move towards it. Some of the problems in there, you have these so-called, for example, Shell pollutes our airspace and pollutes our waterways, etc. But it's got a very high ESG rating because it spends so much of its capex on trying to develop these new ways of energy, and because of that, the rating agencies give them points. Can you believe it? But no, we are definitely moving towards this. In fact, I was very much involved in probably the last sort of few months in terms of looking to put together an ESG type of opportunity. I think the timing's wrong at the moment, not by dint of the fact that we need them, but in terms of the absolute confusion, mayhem that's actually in markets at the moment in terms of how do we value companies. But yeah, we are definitely, it's a growing trend. It's a very exciting trend. It's a trend that we would want to be involved in, and we'll certainly be coming with those.
And I think one of the things that, to remind everyone, what are we trying to achieve here? We're trying to achieve wealth protection, diversification, and income, predictable income. And, really, at the end of the day, some people want other types of products, and I think you know, Stephanie, you're bringing up a valid point. But really, when it comes to the majority of people, when it comes to wealth, if they plan on their 9% and that's what they, you know, need to live on and whatever, they want to know that it's predictably going to happen. And unfortunately, you know, the big I don't know if the right word is behemoths, but the big sort of steady eddies are the ones that are the safest in that space, not the new age wealth migrates, as an example, you know, in terms of, you know, in terms of where it's at. Andili said, on Wealth Migrate wallet, are you able to register companies? So certainly, Andili, I don't know if you noticed, I've got 3 and my personal name. So that's the beauty. I love, and sorry, I'm going to go back to it because this just makes me so excited. When you go to internet banking, you know, you've got different accounts and whatever. I've got everything all in one place. Like, it's all here. So my 2 American ones, my 1 Seychelles one, my personal one, it's all here, and yet it's all managed all in one place. And again, as I said, if I like to feel wealthy, I put it in ZARs, but otherwise you can go in and check whatever currencies and stuff you've got, which I think is just awesome. Sorry, yeah. Again, I see a future, just so that you know, and we've seen this future for a while, but now you can hopefully see the futures becoming much closer to the reality, where I'll be able to sit quite quickly and be able to do pie charts on where my wealth is from a diversification perspective, between countries, between assets, between currencies, and you can see where it's going. I mean, it's already here. We've already got it. Now all the guys need to be able to do is build the functionality into the portfolio basis. And that's where people like Andrew, who are a hell of a lot cleverer than me, and you know, would be able to say, okay, well, this is how we want to be able to show it. But you can see where we're going for us as investors. And the one thing I would say is, you know, there's no need to wait in terms of waiting until you've got pretty pictures. You know, I can still go and have all my returns coming back into one place. Jurgen's asked, from a SA tax view, is this deemed as dividend or interest income? I'm not 100% sure, Andrew, on that question.
Yeah, so it's there's 2 ways of dealing with this. The coupon payment is definitely interest income, okay, but the growth vehicles that we use a coupon as well, that it would be deemed as we haven't shown growth tonight. This is just pure income. There's a growth vehicle that works on the same basis. All it does is it snowballs up the coupon, and it returns it at the end of the period, at the end of term, or we put it into a fund, and that's a CGT event from a capital gains perspective. So yeah. That's the reality of it. There's no simple way of disguising it. It's an income payment. You could, if you wanted to, and this is obviously where planning comes involved, you could start putting wrappers around it, sort of certain types of life wrappers or bond wrappers or whatever it might be. But then you're starting to get into the space of proper structuring where there's a cost involved. You know, wrappers can come at anything from 4 to 6%. They can get really expensive. So straight away, you're taking a knock. But that's a planning and strategy. That's a sort of question answer. That's really, let's look to see, does it make sense? I've seen far too many, over the 20, 30 years I've been involved, I've seen far too many really complicated structures with loan accounts, trustees, interposed companies, boards of directors, boards of trustees, boards of accountants. And at the end of the day, sometimes it actually makes sense to pay the tax as opposed to feed a whole range of mouths who are, you know, providing a service. The value has to be proven. I say that to every single person I come across. If there's a charge involved, it has to show value. I'm the first person to happily pay a charge, but show me the value. Show me that you have, you know, you've proved the concept that you're going to save me a lot of money down the road.
Scott, this is Andrew designing the bow and arrow. This is what he loves. Don't let him go.
No, look, I hear you. And I think also, just to Jürgen, I think you're a wealth partner, and you know, we actually got a tax opinion on the global compliance structure that we're using through Australia, which is then compliant globally and equally compliant with European regulation to protect your money, etc. And I know that Lyndon and the team we paid quite a lot of money for it. And if you speak nicely to your wealth consultant, we might be able to share it with certainly with our wealth partners. So yeah, just reach out to your wealth consultant and they'll be able to help you with that. PK has asked, can a retirement annuity fund invest in Cashbox? Again, Andrew, I'm not sure.
Yeah, so it depends which jurisdiction you're from, because if it's a South African situation, we are constrained by regulations, prudential guidelines through the Pension Funds Act, which has a certain allocation of percentage of what funds can be allocated into these type of structured funds. But surely, yeah, they can. But it's subject to the limit of the actual individual underlying, if it's a retirement annuity or if it's a pension fund.
Cool. And Rachel said, the wallet has our funds in USD. Can it be transferred to GDP for the investment? Yes. So that's the whole idea, Rachel, of why we went with Lemonway versus an American solution. They've actually got multi-currency wallets, and so we can facilitate that. We don't have a pound and euro-based wallet yet. They do have the functionality. Just so that you know, we pay nearly $4,000 a month for all our clients. It's a fixed fee we pay, so that you have no fees. There's no fees depositing your money, there's no fees holding your money, and there's no fees exiting your money. We chose to pay that money so that our clients experience no fees through the entire process. And at the moment, we've just got to build up critical demand for pounds and euros, because otherwise it can be quite expensive per month for obvious reasons. But there's nothing stopping you investing in a pound-based investment or a euro-based investment. You'll still earn your returns in pounds and your returns in euros all back in your wallet. In South Africa, so Andile said, in South Africa, who do you advise who can assist with a tax calculation? Sure. Advise is a scary word to me. So I certainly can't do it, and I certainly can't do it on this webinar. I know that in terms of tax advice, I mean, basically, your standard accountant should be able to do it, although I've tended to find that they don't really understand, particularly once you go internationally. I don't know, Andrew, if you've got any guidance on it in terms of where someone could go to assist with tax calculations, etc.
No, I think I agree with you in terms of I've seen some shocking local advice when it comes to specifically offshore. Especially where you have things like withholding dividends tax in certain jurisdictions, etc. So I would certainly, your accountant should be your first port of call, but in many instances it's not. So they need to be frank, put hand on heart and say, look, I'm not up to scratch with this. Let me recommend you somebody and go that way. You need to, again, going back to one of those slides, right, get the right skill set on your team. Roger Hamilton often says, I don't have enough time to do stuff. And he says, no, you do. You don't have enough team. So each of us needs to build our team, whether it's our financial advisor, whether it's your life coach, whether it's your accountant, lawyer, private banker, whatever it is. Start building up that set of skills. You'll very rarely find an individual who can wear all those hats at once. And if they do, they are quite unique.
So just a quick one. I'm showing on the screen here our directory where we've got property developers, investment companies, immigration specialists. We want to be able to have tax accountants per country, etc. So Pedro recommended Andrew, I don't know how the hell to pronounce that, Labrionis. I'll put that in for everyone else. Jan Hendricks has said BKD auditors. Chad, you've said the same thing. So I'll put that in for everyone else. But I just want to be clear, if anyone's got any good people, please put us in contact with them, because quite frankly, they should be on our directory, because there's nothing that irritates me more than someone like when Andile asks us a question and I can't immediately say, go there and in your country, here's the solution, basically, because that's really where we are, where we're wanting to go as a platform. And again, it's just to provide solutions. And our whole thing is to be a trusted global real estate marketplace in Wealth Migrate, and trusted global investment marketplace with the wealth diversification marketplace. And please, the word trust is important. So as you said, Andrew, just because someone says they can do tax doesn't mean they specialize in it. So it's quite important. Overking is, oh, sorry, Chad, did you have something to say?
I would keen to maybe add an extra on your next steps if you'd like. Andrew and I would love to offer time to the community if anybody wants to discuss the products in more depth, because I know when I first saw it, the stuff was quite daunting. We'd gladly assist, spend some time perhaps I want to do a one-on-one. So if you wanted to offer that as a gift from us to the community, we'd love to put that in. And you could reach us at support@cashbox.global if you'd like.
Brilliant. Thanks. I'll just type that in case.
Shall I do that for you?
Yeah, if you wouldn't mind, that'd be great. So just if you can type it in there. Opaque said, I'm in South Africa. Can I get my income deposited into the USA? So the answer is yes and no. So our wallet system pays you in Europe, but it's a US dollar-based account. So it's no different. You're getting paid in US dollars. If you want to set up an American bank account, we've helped about 400 people do it, plus minus, and it's a flippin' mission. There's no other way to describe it. There's the Patriots Act in America, and you've actually got to physically fly to America and sit in front of a bank. The only way to do it, if you don't have a social security number, which is a green card or passport, you've actually got to set up an LLC, which is a limited liability company. As I said to you, I've shown you, I've got 2 of them. I've had bank accounts, and the American banks are an absolute nightmare. So, Opaque, I would say to you, I would ask you the question why you want to do it. And if it's to have an overseas bank account to earn foreign currency, be it dollars, pounds, euros, I can promise you we've got far easier ways for you to do it, unless there's a specific reason. I can see Chad and Lee have put it in there, so really appreciate it. And Petra's also put in Andrew's number. So if Lee, if you could just post that. I am conscious of the time. We're on or around hop past. What I'd like to do, if there's any more questions, please let me know. There was one question that came through that I think would be quite valuable. And someone said here, what happens if the bank, where was it? Sorry, there was...
Lynn Schoen also had a good one on risk.
Oh, sorry. Yep. So I'll get to that. Yeah. So sounds all great, but what if the guaranteeing bank gets into trouble?
Okay, so let me take that one, Chad. Yeah, it's a great question. I often say to clients when they say, show me the money, that's great. You show me the money, what's the risk? The biggest risk I feel, besides market risk, that is always there, is the selection of who issues this particular product, who underwrites it. So in this instance, it's Credit Suisse that we promote, who is promoting it. So in other words, Credit Suisse Risk and Compliance Department have looked at this because effectively they are writing this guarantee and this contract off their balance sheet. Hence the scrutiny of the bank itself, hence the scrutiny against, how is it rated? Is it an A-rated bank? What's its pedigree? Has it had a litany of fines? Is it going to get into trouble? Is it in a jurisdiction that is reasonably safe? So Switzerland, I think that ticks that box. But no bank, I guess, is safe. Any bank is potentially fallible and can fail. At the end of the day, I think what is really important to us in terms of screening, when IDAD is screening the banks, is certainly jurisdiction, well-governed, well-balanced, very robust, well-regulated, with a long history. And also the country in which it has got its primary base of business. You often find that the Central Reserve Bank, at the end of the day, can also send a lifeline. So in other words, that's the bank of last resort. When we saw in the financial crisis of 2008, 2009, a lot of the UK banks were found very wanting. They had to prop up their balance sheets. They couldn't raise it through debt. So the Bank of England actually stepped in as the bank of last resort. And I was working for Lloyd's at that stage between Cape Town and Switzerland. And I used to say to clients, well, effectively we're banking with the Bank of England now. So if that goes under, we might as well switch the lights off and go home. So it's a little bit of a cynical and snide comment, but and it doesn't mean that your reserve and central bank will always help out the bank. But there's a huge credit risk, and that's why we've got to be so careful in choosing the right type of bank. It's that old adage, Scott, if it looks too good to be true, it's that's the problem. So we could go to a Greek bank or a Lithuanian bank or some of the small tier banks in those countries and get 18%, but your funds aren't going to be there tomorrow. The bank will have gone under because they're just trying to prop up their balance sheet. So we will rather go with big household names, big international banks, big balance sheets. Again, it's not infallible, but I think it separates the, it certainly separates. We also try, in many instances, a lot of the banks We like to have, not with huge lending balance sheets. Because obviously if you lend out, well, that's the problem. You've got to get it back in. So we look at their core tier ratios. We look at all the technical stuff that builds them up into that credit space, which says you're an A-rated bank. So yeah, that is your primary risk. So now if something does go wrong with that bank, let's take the worst case scenario. There's a huge fraud, there's a mis-selling, something goes wrong, and the bank basically declares itself insolvent. What does that mean for you and your money? It basically means that your money is at risk as a creditor in that bank because it's subordinated debt, okay? So you will have to stand in line with everybody else and get something out of that bank. So, you know, it's a bit like, I suppose if it's a question from South Africa, it would be like investing in one of the big four, okay, where potentially the longer term history, the balance sheets, the size is a lot better than maybe a new startup bank. A startup bank probably might not have the same credibility in terms of issuing debt. But that's effectively the outcome if a bank does collapse.
Lynn's got a question. Does the observation look at each company separately, or is it the portfolio taken as an average?
No, it's each underlying investment in that basket. So if you've got 4 in a basket and one misbehaves, let's say all 3 are behaving rather nicely and one misbehaves, that's the miscreant, or the one who's misbehaving, the naughty child, brings the whole lot down.
Perfect. And Hans has said he can help set up a multi-currency account similar to a trust account. So Hans, if you can please reach out to Lee. I know you guys are in contact. We would love to, know the options because, again, our whole idea around the principle of wealth is to be able to provide people with trusted solutions. So yeah, please reach out to Lee, let us know. We'd love to be able to provide people with solutions. So that's all the questions for tonight. I'd like to finish, Chad and Andrew, with, we've been in interesting times in the last 4 months, and we did an amazing roadshow together in March. Funny enough, the last time I saw you was the last time human beings still, got together face to face, basically the week before lockdown. And we had a fascinating sort of roadshow and about where the world was and what was going on in the world. My question to you to finish off, to both of you, both successful businessmen, you're both successful investors, and I'd love to know your closing thoughts on your one piece of advice you would give people based on what you've not only learned over the last 20 years, but more importantly, what you've seen over the last 4 months. And by the way, for the people out there, I'm 100% putting them on the spot, so they had no time to prepare for this.
Scott, you're lovely.
Scott, let me say very briefly. I started my breakdown of the family office in terms of being disciplined. I think you need to have a strategy. You need to be disciplined. You need to have points along your line of your trajectory in growing wealth. In terms of if it's time to bolt down the hatches, you bolt down the hatches. But you've got to be bolting down those hatches with one eye on the current and on the future, because you've got to keep evolving. To steal Standard Bank's perhaps strapline, you got to keep moving. To stand still in one place, if you had to stand still, I certainly believe people who rushed for the safety of cash, if they haven't redeployed their cash by now, they've lost out on the recovery. So they need to be active. You can't be reactive. You've got to be proactive all the time. You've got to be attending webinars like this. You've got to be educating yourself. There are going to be people in the community who either do not understand a structured note, will understand it, but don't want to go into that space. That's fine, as long as you are appreciating that there are so many opportunities that have been cut off to you previously and that are now coming into your space that you need to test. You need to, you need to prod the bag and see what's in the bag if it's really going to deliver. So it's almost like a curious child. You've got to keep learning. You've got to keep educating yourself, and you've got to be open to exploring new opportunities which are within your degree of comfort.
Brilliant. Thank you very much, Andrew. Chad?
Yeah. So maybe to echo what Andrew's saying, I think for all of us to remain the student, Willem last week had such a great slide. Well, you had too many great slides, but the one is be careful of yourself. And I think the message is maybe to design that entire bow and arrow structure. Stick to your knitting, create a team, keep learning, and don't be scared to ask those that have done it before, and go and find out how those that are doing it best do it. You do the same thing in your business. Where the world's going, I'm dying to know. I just wish we could get on and do something now. I'm struggling with cabin fever, I'm afraid. And then if I take our journey, Scott, this last year, in you reshaping Wealth Migrate and August doing what they're doing and the likes, I think in focus lies great answers and so much to unearth. So again, focus on what you're good at, and take your skills, take your rewards, go and invest these wisely, watch your risk, and there's so many opportunities to go and create wealth still, even in this environment. If you're stuck in cash, if your money's sitting in cash in a bank, you're going nowhere fast.
It's so interesting. If people want, and I'll put the link on our Inner Circle group, the TED Talk with Ray Dalio. So if you want to go find the link yourself, just go TED Talk Ray Dalio, and it was in April. And there's one part there where he talks about cash and how dangerous cash actually is. So, you know, he talks about diversification, he talks about cash. I want to conclude with just some closing thoughts for everybody. And if you look here, you know, really for me, you know, family offices manage over $1 trillion. As I said to you, there's somewhere between 6,500 and 10,500 family offices around the world. The average family size that they manage is $100 million. And what you've shared with you tonight is what they're doing. What are their strategies that they're doing? Now, as Andrew alluded, this is even above what some of the family offices are doing in terms of the caliber. But what they're looking for is wealth protection. They're looking for income. They're looking for diversification. And then they are looking for growth in terms of different asset classes, because it's about this generational wealth and, again, not leaving their money in the bank. And I think really what's so exciting about tonight is that what Andrew and Chad have done is that this has truly only and ever been available to the wealthiest people in the world. And now with technology, you can now get access safely and simply to the same asset class. And so I wanted to thank Chad and Andrew for two things. Firstly, I want to thank them as very, very valuable community members for thinking of the platform and all of us that are part of it to say, look, here's an opportunity. Why don't we bring it to the platform? And Chad said something, he dropped it in a nugget on this webinar already, where he said, maybe there's other investments that we all not aware of that should be on the platform. So, you know, we're all ears as to what those are. I wanted to thank Lee and the team for setting this up, and to all of you who've come along and learned, you know, tonight. And we would love feedback. I know Chad and Andrew would love feedback, you know, because what we're always trying to do is how can we simplify the message? How can we enable it? And most importantly, Chad and Andrew, I want to thank you for your time, sharing your knowledge with people tonight. You know, if nothing else, they've invested an hour and a half of their time. And hopefully, if nothing else, they've learned what the wealthiest people are doing. And whether they can do it tonight, whether they're ready or not, at least they've got a glimpse into what others are doing. And one day they can put it in their bow and arrow. So thank you for a great night. Really appreciate your presentation.
Thanks very much, everybody.
Thank you. Cheers. Thanks, Scott.
Thanks for joining us, everybody, and to our panelists, thank you very much. It was a phenomenal webinar. Lots to learn and digest, and I'm sure that lots of people are going to be reaching out to you. So again, if you want to reach out to Andrew and to Chad, please contact them at support@cashbox.global. And then just to let you know that next week we are starting our Women in Wealth webinar series for Women's Month. It is not Women and Wealth because everyone is welcome, but it's Women in Wealth. And we have got some powerful women who are going to be sharing their stories and ideas with you. So we're starting off with Hilda Lunderstedt next week, and she's going to be sharing how a single mom can go from barely making ends meet to being able to afford to move her family all the way to the US and start a new life. So we look forward to hearing from her, and then Janine Basil, and then Anne Wilson, and so many more that are coming online. So we look forward to that. We will be sending out information, but please, if you have any questions, feel free to reach out to myself or anyone on our team. We're more than happy to help you. Hope you all have a phenomenal evening, and we look forward to seeing you in our next webinar.
Lee, we've also got some exciting property partners that will be coming online as part of the series over the month of August as well. So I think the exciting thing is watch the space, keep diversifying, because we're really excited, you know, like with Chad and Andrew, the caliber of the partners coming to the platform now, which is good for all of us as investors.
Cool. Thank you.
Thanks, everybody. Have a good evening.